Hi everyone, this is Sandeep Anand. Thanks for tuning in my channel. The only reason I started sandcompounding.com or my YouTube channel or my podcast in Spotify is to spread the financial knowledge and inspire as many people as possible to start investing in equities and gain from the power of compounding. People get overwhelmed when they hear about the financial jargons, but what if I tell you anybody can create $1 million portfolio and achieve financial freedom early in life? If an average ordinary techie like me who had no inkling about equity markets until the age of 31, who stumbled upon the process of investing, which became my passion, started from that point and created over the last 8 to 9 years over $1 million portfolio and achieved financial freedom. Believe me, anybody can do that. And precisely that's why I've created this video. So stay with me till the end. The next 5 to 6 minutes, I've created a very interesting framework and a blueprint which can be adopted by anybody and implement and invest and achieve financial freedom early in life. Now, this is the presentation I've created. First slide talks about a typical investor's journey. It's a long process, but enjoy the process and the outcome. Final message to take away. Now, here that trajectory shows in the orange line. In the long term, that is the orange trajectory that happens for any investor if you really follow and stay through the course. And during those orange trajectory of long-term gains, exponential gains, which is led by the power of compounding and geometric progression, during this course, there are multiple spurts of ups and downs that will happen. This is caused by the market cycles. And but overall, long term, we will all do good. Now, for my case, I started at the age of 31 with roughly around 30K. And I was a pretty decent saver, as you would have understood by now. And, I used to make a lot of mistakes in the initial 3 4 years because investing was completely new to me, as I said, and I had no idea about financial world. I had to start from scratch, start reading from, ABCs of books and get there. But it was painstaking, but worth it. Now, after first couple of years and 3 years period, I started making lesser mistakes. Mistakes are inevitable in investing, but I have started making lesser mistakes over the last 5 to 6 years. And but during this course of initial 5 6 years, I used to invest only in India because I was in India, and until I moved to US. And Indian market was amazing during that time. I had many multi-baggers during this course, which helped me to get that really initial impetus, like the kinds of Bajaj Finance and Eicher Motors and a couple of stocks like VGuard, which all gave me a good returns. And I lost money in few companies went belly up, like BPL India and all. I had initial years, I used to just understand that you could invest in any company. Now, over the last 6 years, I've started making lesser mistakes, and I have widened my portfolio to a global portfolio. And in 2017, I decided that Indian market is not going to go anywhere and pulled the plug and started investing globally, especially in US markets, which turned out to be, in hindsight, a good decision. Now, one thing I want to take away from this slide is, even if you achieve financial freedom, this is just the beginning, because investing is a very long process. It's multi-decadal process, and 90 percentage of wealth was created by Warren Buffett after he turned 50. Now, I am going to explain the framework which I talked about in the starting, and I'm going to explain that by applying that to my portfolio in the last 2 to 3 years. I don't have the data in the initial 5 6 years because I used to invest in India, and I don't have the records. Now, looking at this, here is what I'm going to explain. So this was my returns. Before coming to here, I'm going to explain about the most important framework that I'm talking about in investing. So there are three pillars: asset-based value, earnings power-based value, and high or exponential growth-based value. Everything is value investing, as the legendary Charlie Munger says. Any common sense investing is value investing. Otherwise, no investors will invest. And I keep hearing this, talks about growth versus value, which is currently talked about a lot. And it's all gibberish, I would say. I mean, here is what it means. There are three types of value. The first is asset value, which means simply value of the business. The underlying assets in the business is much more than what the market is pricing in. So there is a value arbitrage or mismatch which can be utilized for returns. It was propagated by Benjamin Graham. I will do a dedicated video for all this framework, but just on a quick note. The second pillar is earnings power and franchisee power. Primarily, it is the earnings power, future earnings power of the business is not valued by market properly or is on par for the course earnings returns. So this was propagated by Warren Buffett and Charlie Munger, and the whole Berkshire Hathaway investing mechanism framework was based on this thesis of the earnings potential. Now, how that is possible? It is possible only by some driven moat or competitive advantage, which Warren Buffett termed as moat, and it's all about moat investing. Berkshire Hathaway followed that mechanism very successfully about moat investing, and primarily this is on the basis of earnings power and also on the basis of before market recognizes to some extent due to the PE re-rating. Now, the third aspect to it is the value investing is high or exponential growth led by disruptions, value migrations, innovations, primarily driven by technology. Now, one thing every investor needs to understand is there is a complete paradigm shift from industrial revolution in the previous century to a technology driven business segment in the current century, and that is very evident in the market capitalization of the indexes. If you see the top 5 to 6 companies, any country you take, is most of the developed nations especially is dominated by asset light models, and the world is moving towards that. And that's precisely why we are seeing the current bull market driven by digitization. So there are three types of values: asset based value, earnings based value, and high growth, exponential growth, and disruption led value. Everything is value investing. Now let's go back how I applied this in my portfolio. Now in 2018, as I said, I pulled the plug from India, started more of a global investing. So started with US, but one interesting thing I noted, although I started investing in dollar terms, in I could find a asset-based value investing concept to be applied in an Indian stock, which is listed in US as an ADR. Now, it was asset-based value investing, the first pillar, and I did that, and I got at 42.2% returns in 2019. That was my returns, you can see, and it outbid S&P and Nasdaq and all indexes. Now, which was that stock? It was ICICI Bank, an Indian stock, ADR, where I found an extreme value in that Indian private bank. It is the second or third largest private bank in India, and its ADR was trading at a value uh, because the value was in its strategic subsidiaries, which were the assets, and market was not valuing that. Also, there were many positive triggers lined up. So that point of time, the CEO was going through investigation due to a scandal, and but what market in price was onboarding of a terrific CEO, the high capital adequacy they had created, high provisional coverage ratio of 70% in that year for a bank. It's pretty good. And everyone used to consider this as a corporate bank, and the whole non-performing assets was on the corporate side. The bank was transforming itself into a very high powerful retail bank, and their market and retail share of the book was 60%. The whole asset restructuring of the NPA, non-performing loans, leading to some recovery of losses, and whole gamut of reasons. I mean, a lot of subsidiaries were not priced in, like they had a general insurance, life insurance, asset management, home loan. A lot of them were adding up much more than the book value. And the bank was still, second or third largest private bank, so it cannot really go, the government won't let it go down. And so I bought ICICI Bank ADR for around $8 in July 2018, and sold it in January for around $14. This was in January 2019, and it was trading at $14 in sorry, it was in January 2020, but a majority of my holdings in 2019 was in this one bank. So this is the beauty of asset based value investing. When you find this, it is not long term, it is only for a period till market recognizes the value of that asset. As soon as market recognizes, you will only get a 2 or a 3 bagger on this asset type valuation, and you should load up heavy on such kind of bargains when you get it. That's how you typically do asset based value investing. So I did loaded up heavily. 60 to 70% of my portfolio was, you can see that 88% is foreign stock, so was in ICICI Bank. The other foreign stock I held was Mercado Libre, Brazilian or Latin American based e-commerce and payments giant, which also went up 50% in that year. So overall my returns was pretty good in 2019. This was based on the first pillar. Now coming to the end of 2019 or mid of 2019, I realized that once I started selling slowly on the ICICI Bank, I understood that I had to come out of that because I could see a transformation that's happening in the digitization, especially in the US and Chinese market, primarily in US market. And I started buying into the US market in 2019, late 2019 and early 2020. And look at my returns in the first 6 months of 2020. This is what the benchmark index, it's around 116 percentage. And I have outbet the S&P, which is 7 percentage, Nasdaq around 12 to 15 percentage. And this was as of June 2020, but in the last 1 month it has gone up even more, and a lot of it driven by the bull market also. It is not only, and a lot of luck. It's but primarily what I want to highlight is this is the third pillar of what I'm talking about, value investing. So I noticed there is a secular bull market happening in the digitization space in US especially. So for high growth areas, always look for overall addressable market size growth. So if the overall market is growing at a high pace, like cloud overall market itself was growing at 20-25%. E-commerce itself was growing at 16 to 20%. So it's, if you pick stocks in that overall addressable market growth, you will get much bigger returns. That's precisely what I did in the last 1 year. So I started buying Zoom, Viva, Fastly, Tesla, all of them in late 2019, early 2020. Bought Shopify a couple of years back, Mercado Libre a couple of years back, cloud stocks in 2019. So my overall portfolio started tilting towards the digital space and high growth disruptive market segment, and which was primarily pronounced in US and China and some amount in Brazil. Now, these are the 7 areas I found the digitization happening or the disruption or innovation happening. First was obviously the cloud and edge computing stocks. 40% of my portfolio was in US was that, including Fastly, Viva Systems, disruptor in healthcare cloud, HubSpot, inward marketing, MongoDB, the document-based database in SQL analytics world, Twilio, again a cloud play on the API front and messaging front. Then the second pillar was digital commerce, primarily Shopify in US, Mercado Libre in LATAM, Pinduoduo in China, and VIP Shop in China. Third segment is media, the shift from TV to cable, from cable to TV, and death of cable TV was happening. It's still happening, and I got invested in Roku, Trade Desk, Netflix, and all of that. Fourth segment was collaboration, digitization. This was in Zoom, Zscaler, Okta. These are all security play, and DraftKings recent entry in the last couple of months during their SPAC. Atlassian, it's another collaboration platform in Agile DevOps world. Then fifth is payments, the Squares of the world, Mercado Libre, because Mercado is not more than an e-commerce. I like the payments world. I've done videos on all this. You can check in my YouTube. Adyen, a European-based firm, recently entered. Then you have, electric vehicles, autonomous, driven by Tesla and Nvidia, and you have gaming and streaming, driven by Activision, Blizzard, Pros US. It's a holding company of, it's a investing in Netherlands-based stock, holding company of Naspers, and primarily they hold Tencent. It's another way to play Tencent, and Nvidia, obviously in the gaming sector. So I had my portfolio across all of this. So in the 2019, I had a very high concentration on asset-based value investing, where 70% of my portfolio in one stock. But in 2019-20 years, I have at least 35-40 stocks, and it's highly distributed because that's a way to play the high growth segment. You cannot really go concentrated because anything can happen in the digital disruption world. Now what? Now the interesting power is the third segment, which is the earnings power, which is what I'm seeing happening as we move from the second half of 2020 and probably the next couple of years. What is going to play out, because the US growth stocks are slowing down because it is priced to perfection, or maybe to some extent closer to perfection. So you need to find, as a value investor, you need to keep looking for value. And now I'm looking out for the value in the next segment for the next couple of years. And I see a trend happening in the Chinese stocks. They hit the peak in 2015, 2016, all including Chinese indexes. And I see that you can see a trend happening. So follow the trend. A trend happening since mid of June. You see Alibaba's spike here, Neo seeing a spike here since mid of June, Tencent seeing a spike here since mid of June, Huya, a gaming platform, streaming platform in China, small cap, again going up, and Kingsoft Cloud, a cloud play in China. You look at the spike since June mid; it's almost 70% up. So the cloud gaming, same digitization concept is applying, and it's learning led by earnings power, because all these firms are earning like anything, and the price to earnings multiple. That's how you look at a earnings growth, led by moat and other things. You can see a re-rating imminent, bound to happen in Chinese technology stocks and digitization stocks in the next couple of years, and you can already see the trend catching up. So the initial trend is re-rating, but you can see the earnings coming back in Chinese digital e-commerce and technology stocks in the next couple of years. So tilting the portfolio slowly towards that. So this is how you see the value, and this is the third leg, which is going to be driven by earnings, because China is pretty much out of this COVID-19, and you can see growth coming back in China, and the stocks will get re-rated. It's already happening, and also growth will happen. I'm not saying I'm out of US market completely. At least 50%, 60% of my portfolio still is in US technology stocks, because that is a secular market for the next few years. Maybe will underperform a bit due to the high valuation, but still next 10 years US markets will continue to grow well. So it is a digital world asset light model. That is where the value is in the next coming decade. So this is the framework. Now if you feel overwhelmed by these frameworks, and for a common investor, if you find this, I cannot really study stocks, find these patterns, trade, the simplest mechanism is to find an index, couple of indexes, and invest in those indexes. Especially I'm talking about, Nasdaq and Chinese indexes and Indian indexes, Brazil index, these kind of emerging market growth and technology driven, indexes in US. Find them and invest in them if you cannot really find stocks. This is a simple representation and illustration of why indexing works always. You can never lose money in the stock market. I've done a separate video on this. Look at S&P 500. Over the last 93 years, I have collated data. S&P returns, 500 index returns, has been positive on 75%. That is three-fourths of the time. S&P index is positive. That is, it has returned 21% average return over 68 years, and negative 13% return only in one third of the time. That is, 25 years, it has returned 13% negative. But overall, if you had invested consistently in take any period of 10 years, you would have got a return of 10 to 12% including dividends. So this is what is very important concept to take away. If you cannot really invest in individual stocks, please invest in equities through indexes. It's a very powerful concept. And finally, take away, time in the market is more powerful than timing the market. If you are not able to time the market, best way to ideally stay invested for long term, over 7 to 8 to 10 years. And but sometimes you will need to understand when the market prices next 3 4 years of growth, it is a good idea to prune and readjust your portfolio. Nothing wrong in that. But overall, you need to be invested in the market over long periods of time for stupendous return, and hence achieve financial freedom. So this is the presentation I wanted to share, and a lot of learnings in this I have created. And you could pause the slide. I mean, for the paucity of time, I'm not going to go through everything. I'll create a separate dedicated video to go through the learnings. But this is the overall journey I went through, and I'm sure it was helpful for you. I'll dedicate a dedicated video for my learnings as well as on the investing from framework separately. Just wanted to bring this to everyone's attention to start investing today. So thanks for staying with me all this while, and trust this was helpful.